Ladies and gentlemen, good day and welcome to Stanley Lifestyles Limited Q2 FY’25 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nilesh Patil from ICICI Securities. Thank you and over to you, sir.
Thanks, Del. Good morning, all of you. On behalf of ICICI Securities, we welcome you all to Q2 FY’25 results conference call of Stanley Lifestyles Limited. We have with us Mr. Sunil Suresh, Managing Director, Mrs. Shubha Sunil, Whole-Time Director, Mr. Pradeep Kumar Mishra, Group Chief Financial Officer, and Shri Krishna, Chief Executive Officer, Retail Division. Now I hand over the call to management team for their initial comments on quarterly performance, and then we will open the floor for question and answer session. Thanks, and over to you, sir.
Good morning. My name is Sunil Suresh, Managing Director of Stanley Lifestyles Limited. Welcome to Stanley Lifestyles Limited earnings conference call for the second quarter and half year ended 30th September 2024. During the first half of FY’25, Stanley Lifestyle Limited reported revenue from operations of INR 2037 million. Despite our B2C business growing by 3% year-on-year, our overall sales declined by 1.1% compared to H1 of previous year. This was due to combination of factors including reduced store footfall due to unusually heavy rainfalls in our major retail markets, change in our business verticals from credit to cash and carry, and reduced pull from our B2B customers. Although the Indian luxury residential property sales continue to grow exponentially, the ongoing delays in property handover by builders continue to postpone the timing of actual furniture purchase. With more than 17 of our stores being below 18 months and under the gestation period of 30 months, and due to the ratio of new stores under gestation period, we continue to incur higher operation costs, which has put pressure on our current profitability. However, this will even out as the stores start to mature as we move forward. We have managed to reduce our marketing spends compared to the same period last year. Our cost of import raw materials were impacted by adverse foreign exchange movement and increased shipping costs. From a profitability perspective, we delivered an EBITDA for H1 FY’25 of INR 386 million with a margin of 18.9%, and the profit after tax was INR 95 million. On the B2C retail front, we expanded our footprint by opening 3 new stores in H1 FY’25 across each of our brands: Stanley Level Next, Ahmedabad, Stanley Boutique, Chennai, and Sofas & More, Chennai. This brings our net total store count to 64 as at the end of September 2024, comprising of 39 company-owned and company-operated COCO stores and 25 franchisee-owned and franchisee-operated FOFO stores. Our COCO stores contribute 58% of the revenue in H1 FY’25, reflecting Stanley Lifestyles' focus on direct consumer engagement and operational quality control. We have stayed to our annual plan and all the stores budgeted have been successfully launched till date, and we are confident of achieving all planned new store rollout for this financial year. With a better than previous year order book at the start of H2 FY’25, we remain positive to have better business in the remaining quarters of this year. In the medium term, India's luxury residential property market, which is driven by increasing affluent demography, is expected to follow an exciting and high growth trajectory. sales of high-end residences valued more than INR 4 crores or more increased by 38% in the first 9 months of 2024 compared to last year. This expanding market of upscale home owners is creating a strong momentum for quality furnishing and aligned with their lifestyle aspirations. With our well-established brand positioning in a premium and luxury furniture space, bespoke offering and innovative designs, Stanley Lifestyles is uniquely positioned to capitalize on these powerful consumer trends. Management's top priority include expanding our retail network strategically, localization of raw material, and continuing to launch contemporary furniture collections for our target customer base. In summary, Stanley Lifestyle Limited strategy is to deliver value to both our customers and stakeholders while reinforcing our position in India's leading brand in premium home interiors and high-end luxury furniture space. Thank you.
So should we go forward with the Q&A?
No. I'm handing over to Pradeep Mishra, our Chief Financial Officer.
Thank you, Mr. Sunil, and good morning, everyone. I am pleased to share Stanley Lifestyle's financial performance for Quarter 2 and H1 FY'25. For Quarter 2, our revenue from operations stood at INR 1030 million, a decline of 6.4% year-on-year. Gross profit for the quarter reached INR 576 million, representing a margin of 56%. EBITDA was INR 185 million with an EBITDA margin of 18%, while our PAT was INR 57 million, a margin of 5.5%. For the first half of FY'25, which is H1, revenue from operations totaled INR 2037 million. Gross profit was INR 1111 million, with a margin of 54.5%. Our EBITDA was INR 386 million, with a margin of 18.9%, and PAT came in at INR 95 million, reflecting a margin of 4.7%. In our quarterly segmental performance, the retail segment, including Stanley Level Next, Stanley Boutique, and Sofas and More, reported revenues of INR 553 million and a 4.7% increase over same quarter last year. Franchisee stores contributed INR 159 million in Quarter 2, demonstrating strong year-on-year growth of 28.2%. The B2B segment contributed INR 268 million with a slight 0.7% year-on-year decrease, primarily due to softening demand from institutional clients. For the first half of FY'25, the retail segment generated revenue of INR 1061 million, reflecting a 3% year-on-year growth, while franchisee stores contributed 297 million, representing a 17.4% increase, while our B2B segment recorded INR 490 million in revenue with a marginal 0.6% year-on-year decline. In terms of store contributions, our COCO stores accounted for 55% of revenue in Quarter 2 and 58% in H1. Franchisee-owned and franchisee-operated stores contributed 16% in Quarter 2 and 15% in H1. From a regional perspective, the South region contributed to be a stronghold, contributing 76% of our revenue in Quarter 2 and 80% in H1 FY'25. At the product level, sofas remain the leading category in our portfolio, contributing 56% of our revenue in Quarter 2 and 54% in first half FY'25. The company in H1, focused mainly on backward integration, particularly through localizing leather and backward integrating many other processes which, continue to make a complete home solution. As of September 30, 2024, Stanley Lifestyles hold a strong financial position with net cash balance of INR 2112 million. This cash position supports our growth plans, enabling us to expand both our retail footprint and our supply chain capabilities. Looking ahead, we remain optimistic about growth opportunities in luxury furniture market. Our focus will be on expanding our retail network and diversifying our product lines to meet increasing customer demand. In addition, our technology initiatives at the point of sale, coupled with our commitment to sustainable practice, are set to enhance both customer experience and operational efficiency. Thank you. I would be happy to address any questions you may have on our performance this quarter. Over to Saya.
So should we begin with the Q&A?
Yes, we can.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Jaspreet Arora from Equentis Capital. Please go ahead.
Yeah, hi. Good morning. Thanks for the opportunity. Overall, there seems to be a decline in revenue on a YOY basis for quarter 2. Mr. You gave the breakup of the 3 segments, the B2B, franchisee and owned. There it seemed there was a growth and one was a flattish scenario. So, not able to add up these two. And what am I missing?
Yeah. So, our main business is brand and B2B business. And in brand, we have 3 different format stores. So, our brand business in quarter 2, over last year quarter 2, the retail portion really grew by 5%, and which is the COCO stores. And, there was a major impact in the B2B orders, in the B2B segment of our business, which degrew over last year. So retail did pick up in quarter 2, over last year quarter 2, but partially impacted by B2B or the OEM segment. Also, one was the lower institutional demand. Second, we also stopped the credit in our B2B2C division. So that also impacted slightly in quarter 2.
So how much was the B2B down on a YOY basis for quarter 2?
B2B down was 1% over last year, and the B2B2C business, which is some accessories which is sold through dealer network, that was really down almost 60%.
Okay, so major impact has come from here.
We converted that from credit to cash and carry because we were finding it a bit difficult to collect the old dues. So we made it a cash and carry from April. So that actually has de-grown by 60%.
Okay, understood. So amongst the 3 reasons that you mentioned, sir, so this was one of the reasons, and I believe this will continue for the next 2 quarters because you started in April. So even second half would have an impact for this particular reason, right? The change in terms.
There might be a slight impact, but like I said in my speech that we are quite positive because the order books have been much better than beginning of H2 last year versus this year. Point number 1. Point number 2, also a lot of stores which are under gestation are now coming to, I would say, little closer to gestation in the H2 period. So yeah, we see a stable business, and also normally for us H2 gives almost 55-56% of the annual business. So we are now entering a better period of the year.
Okay, and the other 2 reasons you mentioned was one was the rains in unexpected rains in Bangalore, and I believe Bangalore gives more than 50% of revenue. Am I right?
Correct. Yeah. So we had unexpected heavy rains, heaviest in the last 30 odd years in Bangalore. So we had almost 2-3 weekends got washed away. That was one of the major reasons. but I think we have picked up back in Bangalore also.
Okay. And the third reason I missed, so one was the change in terms, one was the range, and there was one more reason you mentioned.
Yeah.
What was the third one?
B2B is slowed down by 1%.
Okay. So second half, would you say that, assuming these things are largely, behind us, there is a potential to grow in if not 20% plus, at least in double digits on a YY basis, 2H over 2H?
We remain very positive in terms of B2C sales, and we think we will definitely continue growing there. B2B is still looking a bit weak. We have not yet got our what they call as forecast for Q3 as well as Q4. So we are hoping that will pick up. The business we converted from credit to cash and carry is already normalizing slowly, and we hope that will be ironed out by end of Q3. So I think we look fairly positioned well to kind of of course, some amount of growth at this point in time. Because of uncertainty of B2B, we are not having the clarity. We are expecting their forecast for Q3 and Q4 very soon, both Toyota and IKEA.
Okay, understood. And just lastly, assuming this delay in handover of...
please fall back in the...
I'll come back. Thank you so much.
Thank you. The next question is from the line of Meg Shah from Prospero Tree Financial Services. Please go ahead.
Yeah, good morning, sir. I just have one question. After the IPO, on multiple interactions with media as well as analysts, you have suggested that the scope for the company's growth is very high, and have almost indicated that our aspiration/capability is to reach 1,000 crore revenue in 3 to 4 years maximum. Having said that, for the last couple of quarters, there has been almost no growth. So if we are supposed to achieve a 900 to 1,000 crore revenue mark, generally it will not scale up overnight. So with that background, I would like to ask you, would you like to downward revise your 4 years indication, considering that the last 3 to 4 quarters have been very muted in terms of growth?
Not at all. You must understand that this has been some internal corrections and changes we have done. Despite the senior management time of 1 year having gone towards the IPO, we came back to business and we have done certain changes which are going to give us a lot more stability. So our numbers are very clear, and all the required avenues to generate these revenues are in place. So there is no correction as far as our forecast of reaching 1,000 crores in the next 3 to 3.5 years is very much there in place.
Okay, sir. That's all from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Sriram Ramdas from Green Portfolio. Please go ahead.
Sorry, can you hear me?
Yes.
Hi. See, on your DRHP, I saw there's something called assignment deed. And from what I understand, the trademark was not registered in the company's name. Is that correct?
No, I'll give you a feedback. The trademark was originally in the name of promoters, and before we filed DRHP, the same was transferred to company, and the necessary application company has already filed, taken all actions to transfer the trademark from promoter to the company. This has to yet get approved by the department and registrar of trademark and others, and as soon as that completes, the entire trademark will rest with the company now.
Okay, you mean before you filed the DRHP, there was an agreement between the promoter to transfer the trademark and copyright name to the company, correct?
Yes. Exactly, yeah.
Okay. But what about the payment? I see the payment is around 50 crores. So I have two questions from this. How did you arrive at that 50 crore? I think 37.5 crores and another 15 crores on the copyright. So how did you arrive at the 50 crores? And secondly, is shareholder money being used for this?
So the total value is 37.5. The copyright is, the part of that is included in 37.5. And this, no part of the IPO proceeds is planned for using in this acquisition.
Okay. And so how did you arrive at this figure, 37.5?
This was done on a valuation on, the brand, the future potential, and then, there was bankers involved which give us a fair value assessment of that. So there was a valuation which was done independently, and depending on that, it was agreed to transfer at a value.
With the free cash what we had.
Yes, it was done with the free cash. I mean, cash flow is also staggered over time. It was not paid as a bullet cash flow.
Okay. And while going for the IPO, did you make any provisions for that, or was this money being used from the reserves to pay the promoter?
It's from reserves. I think again I said no part of IPO money is used for this acquisition.
Got it. All right, sir. Just that one. Thank you so much. Have a good day.
Thank you. The next question is from the line of Resha Mehta from GreenEdge Wealth. Please go ahead.
Yeah, thank you. Sir, just a couple of questions from my side. So one, I think, to one of the previous participants, you were talking something about Toyota and IKEA. So can you just comment on, this B2B, specifically the B2B business? What is the revenue contribution on an annualized basis? Who are our clients here, and, what kind of slowdown are we seeing here? Because, as you said, B2B business has also declined by 1%. And secondly, also on the B2B2C business, that is overall what contribution to our overall business on an annualized basis, and what accessories etc. do we supply via the dealers to what kind of clients? So if you can just elaborate on both these business segments.
Yes. My B2B business contributes about 20% of overall revenue, and the split is broadly 80-20. 80 is more, which I say brand, and 20 is more B2B. And it goes 1-2% quarter on quarter, but on annualized, 80-20 is a good rule of thumb to plan.
So 80 is brand, 80 is own brand, yes?
80 is own brand.
Brand includes retail, accessories, all of that put together. And then there is 20%, which is more where, we manufacture as contract manufacturing and as OEM. That's 20%, and that includes all the OEM names that we cater to.
So like Toyota, IKEA, right?
Yes. Toyota, IKEA and Williams Sonoma is another new account that we have opened.
Okay.
Yeah, I don't know where did I lose?
Yeah, so actually my question was on B2B and B2B2C segments, and you were talking about Williams Sonoma, whom you have onboarded as the latest customer in B2B segment. And so just wanted to understand here that within the B2B segment, so how is the demand outlook, how is the order book now looking like? And also in your B2B2C segment, like which are the accessories, what kind of accessories do you all sell through dealers? And is there also an order book concept there, or how does it work there?
Yeah, so let me explain that in terms of B2B, institutional sales overall is down by 1%, but we have still not got clarity in terms of their H2 forecast, which we are expecting in due course of this month. There seems to be some amount of correction, so we are awaiting their forecast. Normally, it's a rolling forecast they give on a monthly basis. So we're waiting for their forecast. The B2B2C piece is basically where we would trade with certain leather goods and certain leather hides through our franchisees and dealers that had earlier had a long credit period. And due course, first quarter, we realized that the payments were getting further delayed, so we made it a cash and carry business. So that was about 10% of our overall business. That has taken the biggest hit because we moved to cash and carry. But I think it is already getting ironed out, and we are normally coming back to business there. So it should, while H1 took a hit, I think H2 we will, of course, be a bit down, but I think it's more controlled. So between all three, as I said, B2C is 70% of our business. That has grown by 5%. B2B has degrown by 1%, which is 20% of our business. And B2B2C is degrown by, how much is the percentage of degrown? B2B?
B2B, 61%.
61% degrowth in B2B2C, which is 10% of our business.
Right. So now again, on this B2C growth part, right? So it is around 5%, as you said, for the H1 FY'25, right? And even if we look at, the H2, which is almost 55% revenue contributor, right? So even if we see a very high growth in H2, at an overall level for the full year, we will still be growing at, around a single digit number. Now, considering that, you have outlined that real estate project deliveries, etc., are getting delayed. So clearly, the demand, is not seeming to be very buoyant at this stage. So in that light, from where do you feel that, the growth will come? B2B has slowed down. B2B and B2B2C has kind of slowed down. Even retail has slowed down. Then, where do we see this growth coming from? And in the similar line, then would we want to scale down our store expansion network plans of, 10 to 11 stores on an annualized basis? Also because, the new stores are, kind of also impacting the profitability. So your comments there would be helpful.
So, yeah, very important for you to understand, while we have, I would say, demonstrated a lot of success by growing in a cluster, especially Bangalore and Hyderabad clusters, where we continue to increase in Hyderabad. Bangalore, we are more or less completely grown. Most of our stores are now going to start coming up in newer markets. So those markets where we are not present, we are opening more and more stores. So basically, in terms of our store rollout plan, there will be no stopping us, and we will continue to roll out these 11 stores for this year. And then coming back to where it is slightly impacted our profitability is, like I said, almost 17 stores are below 18 months, and they are also aging as we speak, and we are hoping they're very confident that they will start getting to profitability in the due course of next couple of quarters. So while there has been delays from builders, we are also expecting a huge inventory handout to happen probably in the next 3 to 4 quarters. So we know the products are being sold and the builders are handing out, and there might be a huge glut of inventory that is handed over in the next few quarters, and we are expecting that to happen. So we are very confident that we're in the right place at the right time when that happens. So from a B2C perspective, we are absolutely bullish, and we continue to carry forward whatever good work we have done in the last 3-4 years of moving this company from a sofa only to a complete home solution provider. That's exactly how we are going to go about. From a B2B perspective, while certain accounts have been sluggish, there are major plans for these institutional companies. They are expanding quite rapidly, and that also is some existing accounts. Plus, we are also looking for certain key new accounts with good profitability. We have a lot of inquiries from China plus 2 kind of companies who want to now move, and the change in government in America now, I think, is going to also work positively for us, because a lot of people want to leave China because the tariffs on China is definite as far as the new government is concerned. So we remain positive to add a few more good accounts as we go forward. So fundamentally, I would like you to understand, while we would not really want to change the what you call as the way we are conducting our business, which is a 70-20-10, this will continue. Of course, there were certain changes in the 10% business, which is a good thing what we have done, and we are much more secured in terms of our repayments as from the market. So this is how we are doing certain smaller changes, but as I've always mentioned, our mid-term kind of a strategy is well in place. We have been the first mover with more than 20 years of experience in the Indian market, and we continue to grow forward with the new demand coming in.
Right. That's helpful. And lastly, just on the reasons for gross margin expansion, by 280 bits, if I see QOQ or 400 bits YOY. So what was the reason for gross margin expansion? And working capital has also seen a decent spike in inventory days as well as receivable days if we compare versus March 2024.
Yeah. Quarter one, we had a exceptional transaction which was not at the gross margin run rate. We are at about 56% of gross margin run rate from quarter four onwards last year. And quarter one was an exception where it dipped because it was a one-off transaction. Now we've come back on 56% margin, which is significantly improved from last year also. Because structurally a lot of work is happening in terms of bringing efficiency, a lot of localization efforts which has gone in, and those have started to pay, incremental margins immediately.
Forex.
So quarter one was a one-off, and this margin is in spite of we seeing forex going up and increased shipping costs, on imports. We've been able to maintain and manage our margins.
Right. On the working capital increase?
Yes. Working capital, what happened was, so one is when I add a new store, my working capital goes up because of the inventory which is put on display at the store, right? So the inventory levels go up when I, expand new stores. That's one. So that's one reason for working capital to go up. Second was because of supply chain disruptions, because of Red Sea and as a Stanley as a company, we offer a lot of customization and at a quick turnaround time. So having raw material inventory is key for us, and there were a lot of disruptions happening because of non-availability of shipments or containers, expensive shipment cost if you want to book late. So we've strategically held higher inventories, not from now but from last year itself, and then it's gone up. Eventually, with a lot of new programs that we have, at least in the raw material and few import stocks that we had ramped up inventory, we will see it reducing it by quarter four, quarter one going forward, because situation should stabilize and it should help us reduce on the raw material side.
And receivable days, the reason for increase from 18 to 23 days, because now that we have moved to a cash and carry model, ideally the receivable days should have come down, right?
Yes, and these are all sticky collections which are progressing well. We have done good work in October, but then that was one main reason for us to convert and review the credit cycle sales.
But B2B remains as signed up in the past, so
yeah,
that has a 60 days credit.
Right. I have two more questions. Can I squeeze them in, or should I fall back in the queue?
Yeah, you can go ahead, I guess.
Yeah, thank you. So Bangalore would be contributing how much to our overall revenues on an annualized basis?
Close to between 50-55%. So that's
of the B2C revenue or of the overall pie?
Of the B2C revenue.
Got it. And marketing spends, so typically they have hovered around 5%. So I think there was a comment in the investor presentation that we have reduced that. And what was the reason for reduction? And then do we revert back to the old levels? And lastly, just a data question. What is the SSSG across all three formats for Q2 as well as H1 FY'25?
Yeah, from a marketing also, we have strategically started moving from traditional towards mostly social media and other marketing spends. We are still in a experimental mode. We have not gone full hog, and we are doing pilot studies. And also realizing the climatic conditions, we held back a bit, so we did not spend our normal spend in, especially in Q2, we were holding because of the weather conditions, and we have a very, I would say, quick action team where we are able to hold back our advertisement in case we realize there is a certain problem in a certain city. Usually we have these kind of practices in the past. We realize that if there's a weather condition like monsoon or sometimes, also floods and cyclones, we hold back our advertisement spend. So that's what we have done.
Got it. And lastly,
And
on
now
the
I think
SSSG?
in Q2 we are definitely going to come back to normal spends. Already we have started. In Q3 we are going to come back to normal spends. Yeah.
Right. And SSSG?
And SSSG, H1 is trending lower. This is for all matured stores, which is more than 18 months. Again, it's about in lower negative. It's a negative zone in H1.
And negative how much? Like minus mid-single digit or low?
Minus single digit, higher single digit.
Higher single digit. Okay. Fine. And this is across formats, right? Or is there any major skew?
Across all store formats.
Got it. All right. Thank you so much and all the best.
Thank you.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Deepak Jangid from Ants and Bees Investment. Please go ahead.
Thank you for taking my question, sir. So you have mentioned that your target is to do 900 to 1,000 crores top line in the next 3 to 4 years. So I just want to know what is the growth outlook in terms of product categories.
So while we have built this company and brand purely on a single hero product, which has been our sofas for the last decade and a half, starting from 2020, we started adding new facilities to be capable of manufacturing complete home furniture. So we have started upholstered beds, we have started mattresses, we have started kitchens and cabinets. We have also started last year case goods, which is probably one of our fastest moving goods right now. So the transition is on, and like I've been saying that from 2025 onwards, Stanley is going to be positioned more as a luxury full home custom furniture manufacturing company and moving away from the typical sofa only kind of company. So typically when you look at any major furniture retailers globally, sofa as a component delivers between 40 to 45, living room furniture delivers about 40 to 45% of the overall business. We were missing on the various other categories, and we have already started realizing within the new stores that we have set up, the sofa is coming to around 50, 55 and further will drop because we are adding so many new products. So there will be a massive uptick in the attic of our customers. What was roughly about 3.5-4 lakhs by 2020, today in Stanley Level Next, our luxury format is now close to about 30 lakh per customer. So there are two ways of growth we are anticipating. One is of course from new markets, new stores, that is going to be geographical growth. But from the existing stores, we are going to have a product offering changeover that will allow us to go almost 4 to 5 times more than what our previous average ticket size was. So this is the plan as far as B2C is concerned, and that is how we plan to double our business in the next 2.5-3 years.
Okay, and in terms of new product offering, are you planning to go into new products as well in the next 3-4 years?
So most of the new product offerings have been, the factories have been established, the catalogs have been already made, and we are continuing to upgrade. All the new stores are coming with as a complete home solution provider, not like a furniture store. As far as Stanley Level Next is concerned, constantly we have a very strong NPD, almost 150 people working in our new product development area. We have designers from Italy and Germany working with us. Every year we actually obsolete 20 to 25% of the products which have been more than 3 years old, and then continue to add newer products. So it's an ongoing process. But from a presentation of the brand perspective, in the last decade we were known mostly as a strong seating brand or a strong living room furniture brand, but now we are repositioning as a complete home solution brand. That is where we are pivoting to.
Okay, and what is the margin profile product-wise?
So, margin profile, it's product, but now with a complete home, it's also with the customer in mind. And, the idea is to have a complete home solution built. So the margin then gets the discounts or whatever happens gets distributed. So I think it should be at the same range that we are doing now. And all my products are at the similar margin profiles.
Okay. And in terms of, as you mentioned, that with the increased localization and maybe in the next 2-3 years when the Red Sea crisis will not be there. So where do you see the margin going from here?
So with scale, we are seeing a tremendous amount of benefits. We are just in that point where we are moving in terms of getting a larger scale with new stores coming in, and with 100 stores that we have planned in the next 3 years, taking the count to 100 stores from the current 60 levels or 50 last year. So we believe that our margins and profitability, we are targeting to arrive at anything more than 12% of PAT by the end of 3 to 4 years. That is the vision. We have created a premium brand, and we also would like to have a premium profitability.
Okay. Thank you.
Thank you. The next question is from the line of Sanjay Shah from Pranishta. Please go ahead.
Hi. Good afternoon. I hope you can hear me.
Yes, you are loud and clear.
Thank you. Thank you for taking my question. I just want to get a better idea about, you referred to the China Plus One opportunity and a market opening up, particularly in North America because of that. So just want to get a better sense on how big is the international component of your business right now, and where do you think it can go to?
So, just to get your attention on this note, China alone exports over $110 billion worth of furniture globally. Now, out of which close to $70 billion goes to America itself. So the opportunities are absolutely massive, but as of now, India still does not have the ecosystem in place, and we are still kind of building that ecosystem. So probably, at the moment we are exporting through one of our key accounts to various countries such as Middle East, Europe as well as America. But as we go forward, we are a little cautious because while we have a lot of inquiries at our doorstep, we are looking at a product and pricing match, quality product and pricing match. We being a fairly premium brand here, our manufacturing capabilities and our quality standpoints are much higher than typically what they call as repetitive manufacturing Chinese companies, which offer very low prices. So we have a lot of inquiries, but we are choosing the right partners. Where we see phenomenal opportunity actually is a lot of companies wanting to come to India now, establish their retail outlets here, and they want to localize for their own retail expansion. We are in discussion with a couple of them, including a very large Japanese company that is setting up furniture retail at a medium to medium low kind of a price point segment. They have an idea to build almost 300 stores by 2030. So these are our opportunities. We have been the first movers. We have established solid manufacturing capabilities with all registrations and certifications required by these companies. So we do have an opportunity there, but it is not going to be at the cost of profitability, because we continue to, like I said, keep the ratio of B2C and B2B between 75-25. So we not very keen to look at getting into pure B2B, and our business and our intellectual wealth is very much in the brand and the B2C business. Our focus will be here, but while there is an opportunity for profitability, we will definitely take those accounts.
Thank you very much. I think that's pretty interesting, and I'm sure we'll hear more about it over the next few quarters and years.
Sure.
Thank you.
Thank you.
Thank you. The next question is from the line of Shreyas Chandak from Investwell Agents. Please go ahead.
Hi, sir. Good afternoon. Thank you for the opportunity. So, I have a couple of questions. The first one being, when we talk about growth for the next 4 to 6 quarters, Could we actually give an estimate of will it be coming from volumes and what kind of growth would be coming from pricing, considering we're already priced at quite a premium?
So I think it will be a combination of both, because we do have headroom to increase the pricing, because mainly we compete with European brands who have established a lot of brand stores in India, and for them the cost of manufacturing in Italy, Germany and Spain is going very, very high, primarily because of their various issues, the war, the power cost, of course the labor cost, and plus also the forex trading and trending much higher than in the past. So we do always continue to have a headroom to increase our pricing, because the acceptancy level in India also is constantly increasing, and as a fairly matured 20-odd-year-old design company, we know what Indians require in terms of high quality products. So we are able to demonstrate that with better products. And there is a headroom to increase our price as we grow. As far as volumes are concerned, as I said, we are primarily south dominated, and now very carefully each cluster wise we are kind of wanting to grow. We don't like to grow haphazardly, so we are choosing cluster. Hyderabad is next, Mumbai is next, and Delhi NCR is going to be the last cluster where we are going to grow. So this is how we have planned, and as I mentioned, we'll have great opportunities to grow both in terms of pricing and the brand acceptancy, and we have the pricing power, plus also in the expansion of stores and category expansion that we are doing.
Okay, sir. And for pricing headroom, we are talking about all the three formats, being it level, next, boutique, and sofas and more.
So sofas and more, we will have, we consider that as a value premium segment, so we will continue to be fairly competitive there, and that is since our entry level offering. But in Stanley Level Next, we have a good opportunity, because just now, as you know, for the last 2-3 years, premium housings are really selling a lot, and across the country, if you take an average of 4 crore plus, there are a lot of inventory which is already sold, and we believe the high-end customers dwell in these kind of homes, and that market is also going to grow for us.
Okay. So my next question is on the leather automotive interior segment. So I would want some clarity. Is it like a purely B2B segment, considering we do it while the cars are manufactured, or we do more of an upgradement for customers when they want to basically upgrade their interiors after purchase of the vehicle? And if that is the case, then how do we inculcate airbags, considering all the premium cars have inbuilt airbags within the seats?
No. So basically, right now, though the brand started way back in '96 as a custom automotive seating company, we have moved away from that business, and it is still there, but we do very limited number of cars for very high end when they come to our own installation facilities. And we do all kinds of cars, starting from Jaguars to Land Rovers to the Rolls Royce also. We do have a airbag sewing machine, so we can actually do a very high quality custom interiors. But that's a very small business. We do only about 20, 30, 40 cars a month and not more. And because we have scaled down that, but it's a highly profitable business, but a very small business. But most of our business comes with, we supply cut and sewn leather trims to OEMs. So there we supply to car companies, and that is our B2B component.
Okay, and then the car company itself does the final finishing of the entire product.
Exactly. So we do the cut and sew to them, they do the installation in the factory online production.
Okay, thank you so much, sir. That'll be it from my side.
Thank you.
Thank you. The next question is from the line of Pawan Kumar from Shade Capital. Please go ahead.
Sir, I'm audible?
Yes, sir.
Sir, thank you for the opportunity. Just try to get a sense of the size of opportunity we have in India in B2C market. Can you give some color on that?
You will have to consider few aspects that at this point in time, the country is moving from what you can call as standard homes towards premiumization. And if you look at RERA data, there are thousands of builders who are actually developing premium housing across the country in various urban 1 and urban 2 clusters. So the size of the market in terms of organized at the moment hovers between $1.5 to $2 billion. Unorganized could be 80 times bigger. So that is where we are. We are unable to get a tack on how the unorganized market works. But actually the trend is very clearly people are moving towards branded furniture. Usually in developing countries like India, initially people move and start acquiring branded, I would say sanitary ware first, then it would be their light fixtures and so on and so forth, and then the furniture and furnishing comes in. So we are still, I would say, like a 9 AM movement as far as India is concerned for premium furniture. So there's plenty of headroom to grow. Very interesting is one more thing I want you all to know is that while very matured markets like Europe, especially Italy, Germany, 90% of the furniture buying happens mainly for restoration and refurbishment for old homes. But in India, we are seeing a trend where 90% is coming from new homes. So that is the actual trend. So you can see how much more opportunity we have as we go forward.
Thank you, sir. And whom you really see your competitor like in this market like?
While I think from the top end we have various European brands with whom we compete. In the segment as an Indian premium brand, at the point we don't see anyone having backward integrated and having set up a manu retail chain, which is our moat. There might be traders importing from here, there and selling with a few stores. Other than that, of course, we on the national level, we have brands that are playing lower than our segments. But in our segments, at this point, we seriously don't have a straight head-on competitor. And also, I think where we are able to score is close to 75% of our business comes from bespoke manufacturing, and that is what traders and importers can't offer. That is our main USP.
Right, sir. Thank you for such elaborate answer. Just a follow up on this. So do you see opportunity also beyond new homes for your kind of product? Although right now your commentary is coming just for the new homes.
Yeah, because right now the opportunity is so much of new home inventory that we see. That is, of course, the main chase for us. Other than that, we are also seeing a lot of enquiries now slowly coming in because there is a lot of other areas where premiumization has started, which is typically corporate seating, hospitality, airport seating. So we have been indulging and taking a few orders here and there. We have done the entire T2, the new airport in Bangalore. We have done the Cochin airport. We have done the Calcutta airport. So we have opportunities arising, while premiumization in seating is also starting in those markets. So our design team is now engaging in developing a new line of corporate seating, contract seating we call it. So that has already started to happen. So hopefully next year we will open a new segment for premium contract seating.
For new homes, what we offer is a complete home solution. Has been our focus. And for existing homes, when they do a renovation, it comes as a loose furniture. All the furniture which is movable. So we cater to that also. It's been almost like 80-20 in terms of new home to old home sales ratio for our retail division.
Okay.
So we cater to existing also, but the growth in new homes is high, and then that's where new home sales is taking away.
Okay, sir. Thank you for all your answers. That's all from my side. Thank you.
Thank you.
The next question is from the line of Naitik from NV Alpha Fund. Please go ahead.
Hi, sir. I just wanted your revenue breakup by segment for Q2 FY'24 and possibly for H1 FY'24 in terms of seating, case goods, leather, auto, etc.
Pardon me, your voice was not very clear.
No, sir. I wanted the revenue breakup for, seating, case goods, leather and auto interiors, in Q2 24.
Yeah, and it is there in our product presentation. I will.
No, I meant for last year 24, not this year.
In terms of percentages, I think this data is included in our investor presentation.
It was only for this year, not last year.
FY'25 you want, is it?
No, for Q2 FY'24.
No, I think the ratios remain same as H1. It doesn't change much between quarter 1 and H1. So we should estimate the same H1 trend.
Year over year, right?
Yeah.
Okay, sir. That's it from sir.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you very much, all of you, for joining us today and for your continued interest in Stanley Lifestyles Limited. We are excited about the path ahead and remain committed to delivering consistent growth and value in the coming quarters. As always, we have any further questions. If you have any further questions, please feel free to reach out to our investor relations advisors, Churchgate Partners, and we'll be happy to address all your queries. Thank you once again.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.